Glyn, here we are, early July, reflecting on the month of June, a month where it's fair to say most things went up.
Most things went up. Continuing the trend, actually, over the first half of this year, most asset prices went up in the first 6 months of the year. So unusual, bonds, equities, commodities, all going up in value. Some exceptions, but a good year for markets generally, and June continuing that pattern. I guess led by the US equity market's up 7% so far this year, including a 2% return in June. But perhaps the single most extraordinary thing that's happened this year is bond markets, where, if you recall earlier in the year, most people around the markets were pretty negative about the outlook for government bonds in particular, with yields at low levels. Well, here we are, yields quite a bit lower, and probably the best single performing asset this year has been long-dated US Treasury bonds with a return of nearly 14%. So a good 6 months for markets generally.
Clearly one of the main causes of that shifting in bond yields is the continued monetary policy activity.
Yes.
ECB are the sort of most noteworthy proponents of that this month.
Look, without question, markets have been driven by what's happening with central banks. And as you rightly say, the ECB early in the month, partially as expected, loosened policy further. And I think some quite significant moves. First of all, they cut interest rates again, only modestly, but there was a very important message in that they cut the deposit rate into negative territory. So in other words, if a bank wants to deposit money with the ECB over and above its minimum reserve requirements, it will get back more than it put in. That's pretty extraordinary. That happens extremely rarely in history. It's never happened with the ECB before, of course. And then the other thing they did, which again was important, an important component of reducing bank funding costs and providing more credit to the economies generally, was to provide pretty much free money to banks, a fixed interest rate of 0.25%, a quarter of 1% for the next 4 years to European banks on condition that they increase lending. So it's more or less free money being handed out, and obviously is designed to provide more credit into the economy. I think two other important points. The ECB sort of indicated that they are highly unlikely to increase interest rates until at least the end of 2016. So we're a long time away from seeing any increase in rates. And the second thing is that they have indicated for the first time that they are looking at quantitative easing in the form of buying effectively mortgage-backed securities, something they, again, have never done. I think we're some way away from that. I don't think the ECB will do that anytime soon. They're going to wait and see what these further easing measures will do to help boost the economy. And I actually think the economy is just gradually on the mend across Europe anyway. So they probably won't end up doing it. But it was a very significant easing move and pushed European bond markets to levels that we have never seen before, quite literally never. So Spanish, Italian, French, Dutch bond yields are at multi-century lows. We've got records going back over centuries, and we've never seen these levels before. So these are pretty extraordinary times we're seeing, and has produced some good returns in European markets again.
Undoubtedly. Just on the negative interest rates, I think you said banks get back more with their excess reserves. Just to clarify, they'll get back less.
They get back less, thank you.
Yes. Let's move on to the Fed. QE tapering continuing, although they've got a pretty weak GDP print in the first quarter.
They did. The tapering was not a surprise. Incidentally, they're going to carry on doing that. The important point about the weak GDP number, which was revised down to minus 2.9%, quite a sharp contraction, was that it was almost entirely due to the severe winter weather. Big chunks of the economy just simply couldn't work. Construction more or less stopped in those very difficult conditions. All the evidence is pointing to quite a sharp bounce back. Whatever you look at, consumer confidence is at the highest level for several years. Really reliable leading indicators like purchasing managers indices are at the highest level for 3 years. House sales are at the highest level since May 2008. Business confidence is picking up. The unemployment numbers have been coming down. Job creation remains good. There's no question that the US economy is going to bounce back quite sharply, not just in the second quarter, but through this year. The Fed did revise down its overall forecast for the year, because when the economy contracts by nearly 3% in the first quarter, you can't expect it to grow quite at the same pace for the whole year. But there's no doubt there's a recovery going on as we speak, and it's a positive and I think broadly based recovery.
Talking of recoveries, the Bank of England flagged reasonably high chance of a rate rise coming up.
It did. Well, that was the other significant move in the month, as a matter of fact. The UK economy is actually enjoying a very robust recovery. As you know, we've been positive about it for 18 months or so, but I think it's surprised a lot of people, including many at the Bank of England. And what the bank is concerned to do is to avoid the risk of excesses building up, and it's particularly mindful of what's happening in the property market. London residential real estate is probably in or close to a bubble, having risen again very strongly over the past 12 months. The bank obviously wants to control that. It has actually tightened mortgage lending criteria during the month, and as you say, Carney indicated that market expectations for the first interest rate rise are probably too optimistic. In other words, he was implying they may raise rates during the course of this year. I still think that's probably unlikely, but it's now a clear possibility. He obviously will be concerned. He doesn't want to nip this recovery in the bud, but it is a broadly based recovery. It's right across the country, many sectors doing well, manufacturing doing very well. So it's only a matter of time before they do increase rates. But it will be gradual. And the likelihood is that in this cycle, rates will not go back to the levels that we saw in the pre-crisis period. Mm-hmm. So maybe they get back to sort of 2.5%, 3%, something like that from the current 0.5%.
Mm-hmm. Let's move east then, and to everyone's favourite economy a couple of years ago, China's had a pretty torrid time here today. Torrid time.
The economy's struggled. We know they've got this problem with too much credit in the economy, which they're trying to rein in, and it's a difficult balancing act, trying to produce 7.5% growth, which is their target growth, whilst reining in a credit boom. That's tough. And we saw some quite weak activity in the first few months of the year. What the People's Bank of China has done, their central bank, is actually start to ease monetary policy a bit, easing reserve requirements on banks. And I think we're beginning to see the first signs of this easing coming through. The leading indicators coming out in the past month or so have actually been a bit better. And that's been a factor definitely in helping markets across the board to improve, including commodity markets. So I'd say that we've seen the worst in China in the last few months, and we will get a gradual recovery. But as we've said consistently, China's growth path is towards a much lower level than the 8-10% that we've seen historically. It's going to, in our view, come down to more like a 5% level over the next several years.
A neighbour of China who would love a 5% growth level is Japan, of course.
Yes.
Difficult start to the year, but things improved in this last quarter.
A lot, yeah. Japan was one of the worst performing markets this year. It's still down year to date, but it's had a big recovery in the past 6 weeks or so. In fact, from the lows, it's up by nearly 10% now, including over 5% return in June. And I think there's a couple of things that's triggered that. One is that the big increase in the sales tax, which took effect on April 1st, people were worrying that would actually produce a prolonged slowdown in the economy. Of course, the economy did slow down in April because spending had been brought forward, but what we've seen is actually plenty of signs of recovery. The other thing is that Abe's third arrow of reforms have been a bit of a damp squib to date. The market's been disappointed by them. He has, though, started to get a bit more realistic about those. He's announced corporation tax cuts, other sort of business-friendly moves. So the market's beginning to think, well, he's not going to let go of this. So the three arrows, monetary policy easing, fiscal spending, and then these further reforms, structural reforms, I think will end up resulting in Japan performing very much better. And the market still is actually quite well valued. So yeah, we're still pretty positive about Japan and still got some way to go, I think.
Let's move then from economics to politics. ISIS activity in northern Iraq reminds us once again that there are risks out there despite low volatility.
Well, that's the point about this. A few weeks ago, none of us had really sort of heard of ISIS or focused upon it. Suddenly, they're controlling great swathes of eastern Syria and Iraq, and the markets initially were quite alarmed by that. The speed of movement was clearly very alarming. What has happened, though, is that as they've moved into more sort of Shia-dominated areas, the pace of movement has slowed and more or less stopped. So they're not in Baghdad. They're nowhere near the big southern Iraqi oil fields, and that's where Iraq produces its 3.5 million barrels a day. So, interestingly, although the oil price blipped up a few percent on the news of the ISIS advance, it's actually lost a third to a half of that movement, as the market has realised that Iraq is still exporting the same amount of oil. At the moment, ISIS has no control over those big oil fields, and actually pretty unlikely to. I think there's going to be a lot of support coming in from a lot of places to prevent that happening. But this is a problem that's not going away anytime soon. A redrawing of the Middle Eastern maps is a likely consequence of this, and it makes the whole region, again, pretty unstable and quite a worry. And I think certainly increases the terrorist threat in the West. But at this stage, as long as ISIS doesn't get to control those big oil fields in southern Iraq, I don't think it's going to be a big market-moving event, although of course it did push up the gold price. The gold price up 6% in June, 10% for the year now, and I suspect quite well underpinned.
Talking of well underpinned, M&A activity keeping the equity market well.
Absolutely extraordinary. Yeah. Over $2 trillion of M&A activity in the first half of the year, nearly 80% up on last year, clearly underpins markets. It is a little bit of a warning sign. Often when you get this surge in M&A activity, it's a bit of a sign of excess, and that's one thing that we are looking out for all the time across markets. Certainly the central banks are. The Fed has made it clear they're worried about the high yield debt market. In fact, Yellen has mentioned it in her speeches twice in the last month. It's clearly in their sort of concern basket. The reason being that junk bonds have been issued in huge volumes, yields have gone in absolute terms to all-time lows, spreads against treasuries are close to all-time lows. So this looks like an asset class where the risk isn't being priced appropriately. But on the whole, there aren't huge pockets of excess. Valuations in equity markets still look okay. We still think there's going to be further upward progress in equity markets over the next year or two. Economies in the developed world are definitely picking up, but picking up at a rate which will not push inflation materially higher for the time being, and monetary policy is going to stay fairly loose. Yes, we're going to get the first rise in interest rates within the next 12 months in the US and the UK, but I don't think it's going to be so well flagged, I don't think it'll be hugely damaging. So I think there's still a good underpinning. We do have concerns about what's happening in bond markets. Yields are really at such low levels that you've got to say, as we go through this cycle, this can only be bad value from here on in. So there's concerns there, but there are still pockets of decent value in bond markets. Emerging market debt, which has been a very strong performer this year, up nearly 10%, that still looks reasonable value after that poor performance 2013. So there are pockets there, but it's a time to be slightly more cautious, to remind ourselves that we're living in the most extraordinary times in terms of monetary policy, where we've got these conditions that we have never seen before, both in terms of low interest rates and huge amounts of money being printed. And extraordinary times invariably result in extraordinary consequences. So we need to be mindful of that. So it's a time to take stock a little bit, not to reduce risk, but to make sure that risk is appropriately placed, and a key focus on valuations. But a little setback wouldn't be particularly harmful. I think it'd be quite healthy to markets. But certainly, as I say, over the next 12 months or so, I think we can see more progress, particularly in equity markets.
Great, thank you, Glenn.